The stock market is crashing. Welcome in, guys. My name is Domenico. Today, we're going to be discussing some potential reasons why the stock market has been acting absolutely crazy recently and what I'm doing about it. Am I buying, selling, holding? What am I doing with my personal portfolio and my suggestions on how to act when a market is acting this crazy as it has been doing in the recent weeks. Now, before we do get into the video, don't forget to leave a like down below. It just takes 2 seconds. Just click that like button. It really helps me out. And also subscribe to the channel and click that notification bell so YouTube notifies you whenever I post a new video. But apart from that, let's get straight into the video. So last week, a lot of big tech companies came out with earnings. Apple, Amazon, Google, all these companies came out with earnings. Now, their earnings were phenomenal, and we'll run through them really quickly in this video just to see how the market has been reacting to these phenomenal earnings. So firstly, we have Apple, and they reported sales up 54% year over year, and they announced a $90 billion share buyback. So looking at these numbers really quickly, EPS came in at 140 versus 99 cents expected. So a huge beat there. And revenue came in at an 89 billion versus 77 billion expected. A huge beat there, right? And they beat across the board, right? So you might be saying, okay, well, Apple stock must have been up substantially, right? Well, actually, no. The stock has been down ever since they reported those earnings. Doesn't make sense, right? Well, let's get into the next one here. Alphabet. Alphabet reported a big earnings beat as well. They had EPS of $26.29 versus $15.82 expected. Almost a double up there in the EPS. And revenue came in at $55.3 billion versus $51.7 billion. Also, a substantial beat. You might be saying, okay, well, maybe Google was up. Maybe Google stocks was up after these earnings. Well, actually, no. It's been down ever since. All right. Looking at Amazon. Amazon sales surged 44% as they smashed earnings. EPS, $15.79 versus $9.54 expected. Revenue of $108.52 billion versus $104.47 billion expected. Amazon stock must have been up. Actually, no, it was down substantially. Even on that specific day, the day that they reported those phenomenal earnings, the stock was down, and it's been down ever since. What gives? Well, we'll be going through a few of the reasons why I believe this might have been the case, why this is happening, and what to do about it. So firstly, the first possible reason is the Biden capital gains tax increases, the potential Biden tax increases. Now, Biden is looking to increase that tax rate to as high as 43.4% federally. Now, what does this mean? Well, currently, long-term capital gains in the United States is 20%. An increase to 43.4% is more than a double up. And when you take into account the state's income tax, places like New York and California would be over 50% for people making over $1 million a year. Now, how does this affect the stock market in the short term? Well, people that have a lot of gains in their stock portfolios are going to probably, if they believe that this is going to go through, which it's not confirmed yet, but if this does go through, they're going to want to sell their stocks before that to take those profits and pay only a 20% income tax versus a 43.4% income tax, right? I mean, if someone's going to tell you, okay, your taxes are going to go up on January 1st, well, you're going to want to avoid paying those taxes and selling your capital gains earlier, right? So taking the 20% instead of the 43.4%, right? So this could negatively impact the market in a substantial way. And this could be one of the reasons. Again, this is not confirmed yet. However, this could be one of the reasons people are panicking and saying, wow, I have to get out of my positions here. I'm up substantially. I don't want to pay 43.4%. I'm going to take the 20% hit instead of the 43.4%. So that could be one potential reason why the stock market has been going down the way it has. Number two, we're going to be looking at some valuation metrics here in terms of PE ratios. So if we look at the large cap, the S&P 500 large cap index, we have a forward PE ratio of 21.7. Basically, the only point in history that we've been, or at least recent history, that we've been higher than this is during the dot-com bubble. Now, you never want to be comparing yourself to the dot-com bubble. The dot-com bubble was an absolutely crazy time in terms of valuations of stocks. Stocks that didn't have any revenue were trading at billions of dollars in market cap, right? Just simple ideas would get billions and billions of dollars in funding. Sound familiar? Well, yeah, SPACs. SPACs, basically, some SPACs are phenomenal. However, most SPACs are complete garbage. They're just ideas with billions of dollars backing them. So it's a very scary time in terms of comparing yourself to the dot-com bubble. Now, if we look at the mid-caps, we're at a 19.4 forward P. Pretty much the highest we've been. Yeah, that's not a pretty look. And also, if you look at the small cap, it's the same thing. Pretty much the highest we've ever been, at least in modern history, since 1999. That's never a good look. You never want to be as high as you've ever been in terms of valuation. So what does this have to do with actual stocks or why the stock market's going down? Well, a potential reason for why the stock market's going down is possibly because valuation simply got too stretched. Potentially, valuations were simply just too high, and at a certain point, they have to come back down. And maybe this is that point. But what triggered it? Well, if we continue here, the median forward P in the S&P 500 is at a 20.9. Pretty much the highest we've been since 1982. Apart from the dot-com bubble, again, this is pretty much the highest we've been. Very scary statistic. Now, something I also saw on Twitter is that if you invested $1,000 into the following on January 1st, 2021, you'd have this much as of May 4th. If you invested $1,000 into Tesla, you would have $907 now. You'd be down on Tesla. GameStop, you would be at almost $9,000. You're up 9x in GameStop. Bitcoin, $1,946. You're almost at a double up in Bitcoin. Dogecoin, if you put $1,000 on January 1st of this year, 5 months ago, you'd be at $103,703. Almost 104x in 5 months. If we look at Dogecoin just in this past week, it's been over a double up. The market cap is now pretty much at $70 billion for a meme currency, for a currency that was created as a joke. $70 billion. If we look at Ethereum is a little more serious coin here. It's worth $387 billion. However, in the past week, it's been up pretty much 30% in a week. And that's $387 billion market cap. So what does this have to do with anything? Well, again, this could reiterate that the market is simply being too speculative right now, or it was being too speculative, and valuations have to come down. And potentially this is why the market is falling, to bring those valuation levels back to a normal level, pretty much. What's another reason this could be happening? Well, last week the Fed mentioned that they're going to keep key rates at near zero and that they see inflation being transitory. Now, what does this mean? Well, transitory inflation means that inflation will happen in the short term. There will be significant inflation in the short term. However, it will not persist for the long term. So the Fed is agreeing that because there was a huge influx of cash basically into the economy in the past year, yes, there will be a significant increase in prices. However, they do not believe that this will be sustained over the long term. They do believe that this year we will have high inflation. However, we will be going back to the 2% target rate. Well, just today, Janet Yellen, the Secretary of the Treasury, is disagreeing with Fed Chair Powell. Now, a lot of market participants have been disagreeing with Powell. And now that Janet Yellen is also disagreeing with him, this is a cause for concern, because you never want the two main people that are in charge of monetary policy to be disagreeing on what's going to happen with interest rates. Janet Yellen is very credible when it comes to, because she was a Fed chair at one point, and now her saying that they might need to increase interest rates give credibility basically to those market participants that think that interest rates are going to rise. This is not good, because people are going to be losing credibility in the Fed, and when Jerome Powell says we won't be raising rates anytime soon, they might not believe him, and they might push the interest rates to increase through the market. So right now the 10-year is at a 1.593% yield. A lot of economists are saying this might be going to 2% in the very near future, because inflation is going to be extremely high and it might not be transitory. It might actually persist for the long term. This would be devastating to high growth stocks. For example, Enphase Energy. Enphase is a huge growth company. And why would this affect a huge growth company like Enphase? Well, when you're projecting huge growth rates for the future, you're going to be potentially projecting cash flows in 10 years, for example. Well, when you're discounting at a 1.5% rate versus a 2% rate, this gives a massive difference in terms of the valuation of the company today, the present value of it today. So if rates continue, if they actually do have to increase them in the near future, high growth companies will continue to decline as they have been doing. However, Fed Chair Jerome Powell says they will not be raising it at least until 2023. So we don't know who's right. It could be Janet Yellen. It could be Fed Chair Jerome Powell. At the end of the day, it's the Fed that decides if they're going to raise or keep rates stable, right? So potentially, Janet Yellen's comments today could have spooked the market in terms of her disagreeing with Fed Chair Jerome Powell and saying that interest rates may have to rise. And this caused stocks, again, like Enphase, to decrease almost 7% today. Now, what am I doing in this kind of market with my personal portfolio? Well, am I buying, selling, holding? Well, when stocks like this go down, and I believe that the fundamentals support the stock being higher than where it is now, I simply buy more. Just today, Corsair Gaming came out with earnings. I made a video about this earlier today. Their earnings were phenomenal, yet the stock fell substantially, in fact. I think at the end of the day, about down 3.5%. So I bought some Corsair. Enphase was down almost 7%. I bought some Enphase. Tattooed Chef was down. After that amazing acquisition, I also made a video about yesterday, the acquisition was amazing and it went down. I bought more. When the companies you love go down in value, that's a time to buy. You're getting a better deal than you did in the past, even though you love it just as much, if not more, with the news that just came out. So yes, I do believe that right now is a fantastic time to be buying. Again, you always want to average in because you don't know if the markets are going to continue to fall. If they actually do implement this capital gains tax increase or increase interest rates in the short term, this will substantially impact the market overall. So you always want to be averaging in your buys. You never want to buy at one time, one shot, one huge purchase. No. You want to average into the market, but you want to get in the market. All right? Even though the stocks may fall further, you want to buy in because you never know when the bottom is going to be. So I really hope you enjoyed the video, guys. If you did, don't forget to leave a like down below and subscribe to the channel as well as clicking that notification bell so YouTube notifies you when I post a new video. But apart from that, I will see you in my next video. Have a great day.